Good afternoon. Welcome to Real Estate Raw. I'm Bill Ham. Today's topic, we're going to be discussing how to work with big lenders versus smaller lenders, commercial lenders, right? What we're going to be doing, I want to break it down into two types, okay? We have what we call transaction-based lenders and fee-based lenders. Those are the two different types of lenders that we have. We're going to kind of break that down. Now, what I'm talking about is big lending and small lending. There's lots of different ways we can categorize this, but I'm going to say fee-based lenders and transaction-based lenders, large cap groups and small cap groups. All right, let's start off with transaction-based lenders. All right, transaction-based lenders are exactly what they sound like. They're making their money based on the single transaction. That's going to be agency debt. That's going to be your large commercial lenders. DUS lenders, delegated underwriting servicer. I'll go over that. But that's going to be basically what I'm talking about, your agency loans, right? And I say agency because that's the our GSE, government sponsored enterprises. That's Fannie Freddie, right? So we're talking about over there. They make their money by charging you a point or 2 points when they transact, when they originate that loan. But you don't go over to Fannie Mae or Freddie Mac and get a debit card and a checking account. That's not how that works, right? They're not banks. They are just strictly lenders. All right, so now we have banks or smaller cap lenders, and those are going to be fee-based lenders. All right, now this is important because the way these banks make money is how you want to think about working with them and communicating with them, especially when you're talking to the smaller, more community banks. All right, so local community bank of somewhere, that kind of lender is a fee-based lender. They don't really make that much money on your loan. They make money from all of the global business that you as a new customer bring to that institution. And that's a very important concept you want to stop and think about. So when you're talking to local bank or bank of somewhere, you don't walk in there and strictly talk about a loan and interest rates and how much it's going to cost to get a loan, and that's it. You want to talk to them and be discussing all of the accounts that you're going to be opening up. You're going to be managing the property. You're going to be opening up tenant deposit accounts, and they're going to need some debit cards, probably for your credit card. That's the conversation you want to be having with a fee-based lender or local type bank. So when you're out looking for a loan, be willing to do business with that bank. Therefore, my tip is when you first start going out looking for loans on smaller, let's say sub $2 million properties, things like that, start off with the bank that you have a checking account with. That's where I always tell everybody to go to. Wherever you do your normal banking, just start there. You already have a relationship with that group. They already know you. You already have this global business with them. Why not, right? And it's easy. These kind of local lenders are easy to work with. You can go in. You can just set an appointment. You can even walk in the door at most branches and just ask to speak to a banker. And if they're not on lunch or whatever, you just wait a few minutes, sit down, talk to the banker. And that's a great way to get sort of a free lending education. Go in, talk to them, find out health checkup. Hey, how do you look at me? What kind of things would it take for me to borrow? What are you looking at these days? How's your bank looking at multifamily? What kind of rates you have? These are all things you want to be doing these days. But that's a local bank, right? And that's going to be your fee-based lender. All about the relationship, all about the ancillary fees that they're going to make when doing business with you, not just loans. Fannie, Freddie, they are strictly debt service ratio, right? They are much tighter. They are going to be looking at you heavily as the borrower for several major points. Number one, net worth equal to or greater than the loan amount. This may also be true over at Community Bank, but it's absolutely true at your big lenders, agency, and all that. So it's going to be net worth. Now remember, net worth meaning whatever your balance sheet says you're worth. It's your assets minus your liabilities. So it's going to be net worth equal to or greater than the loan amount. The property is going to need to be at a 1.25 debt service coverage ratio, right? Just quickly for anybody who don't know, DSCR, right? That's the net operating income ratio to your mortgage payment. So if you have a 1.0 debt ratio, that means you have $1 of NOI to $1 of debt service or mortgage payment. your break even. That's not good. And so the bank wants to see you with about a buck 25 of, or excuse me, the agency wants to see you with a $1.25 of NOI for every $1 of debt, 1.25 debt ratio. So right there, you're probably going to be with agency debt, 65% loan to value is kind of what I'm hearing more of these days. If anybody out there has got anything different lately, if you've talked to your mortgage broker or lender, post over there and let me know what you're seeing as far as like terms and rates and things like that. But I think agency debt is around 6.5, 6.75 ish on rates today. I kind of follow it here and there. If anybody's seeing anything different, let me know. But that's going to be with, again, that 1.25, maybe 1.3 debt service ratio and like kind experience. All right. That's the one that a lot of people are not familiar with or less familiar. When talking to these commercial lenders, and I'm talking big ones, they normally want to see that you have experience equal to whatever it is you're trying to borrow against. So if you're looking at 100 units, like let me say the first time I ever got my first agency loan, it was on a 152 unit deal. That's actually for sale today. So it was a 152 unit deal in Macon, Georgia. I did not have 152 units experience all in one property like that, but I did have 150 units worth of other properties, some 10s and 20s and a 50 or two, this kind of stuff that added up. So the lender decided I had enough experience to equal that. But 3 years, they're probably going to want to see you have owned that type of property or equal amount for about 3 years. So if you are underwriting a deal and you think this is a deal that I want to take to agency and you're kind of underwriting it with agency terms and you do not have that experience, nor do you have that net worth, understand that you may need that partner going into that deal if you're going to try and use that kind of debt. So you want to factor that in when you're doing your underwriting. Speaking of underwriting, we are having a boot camp. I see Miriam here. I'm here. We're having a boot camp coming up. I'm having a boot camp hosted by Miriam and the Tampa Bay multifamily group down here. And it's going to be May 4th and 5th. So I hope you all got our email on that. We can certainly put a link to it in here. But I hope you sign up. It's going to be an underwriting, 2-day underwriting event down here in Tampa, Ybor City. It's going to be really cool, really fun, heavy on math. Everybody bring your calculator, your tablets, and your computers. We're going to be doing a bunch of case studies and working together. So it should be a really good event, 2 days coming up. Hope everybody comes down, come see me then. All right, so that's what we have on the working with or getting loans with these type of lenders. All right, let's talk for a minute about operations with these type of lenders, debt servicing, and let's also talk about if you ever happen to get in trouble with one of these two types of lenders. So we talked about buying from them, borrowing from them, operations and servicing. Now this is something Monica and I specialize in. It's asset management and sort of helping people move forward in their business and manage. Monica is very heavily based on the software and implementation, helping people go lateral. So if anybody's trying to go lateral in their multifamily business, certainly reach out to Monica. If you need just sort of asset management help, call us, either one of us. All right, so the working with this lender. All right, now what I've found is in the servicing of these, just the day-to-day paying the loans and things like that, they're much easier to work with the local lender or the fee-based lender, right? It's easier to get in touch with them. It's easier to negotiate. You can usually deal with the person that wrote the loan. You may know the manager, play golf with them, that kind of stuff, right? So it's just a lot easier to negotiate on that side. When you're talking about agency debt, understand you are dealing with a machine. There is no negotiating with agency, right? Once that loan is created, it's been collateralized. It's been put into a fund, a CMBS, a commercial mortgage-backed security, right? And by the way, long story, but that's what agency does. They buy mortgages and then they pile them into a big pile and they sell shares. So they've put your loan into this big pile of all these shares, and that's why it's non-negotiable once that thing's created. I have seen a lot of people come in here and say, gosh, my agency loan has a big prepayment penalty, right? We probably all know about that. That's defeasance or yield maintenance, things like that. But if you want to kind of get out of a agency loan early, there's just a big prepayment penalty. And I've had a couple clients come in and say, gosh, well, I'm going to call up Fannie Mae and just see if they'll waive that prepayment penalty. Because if they'll just waive the prepayment penalty, then I can sell the property and I won't go into foreclosure. Trust me, you are going into foreclosure. Agency is not going to go waiving fees and waiving stuff like that. They don't care. You're nobody to them. You're a small potato. They're going to grind you up, spit you out. So be very careful when using that kind of debt, that you underwrite the deal and you know what you're looking at. Because once you get into that kind of loan, they're very difficult to get out of, and they're not very negotiable. So I would suggest that going forward, if you are looking at doing renovations, you're looking at kind of doing any big value add, or you're spending a lot of money on the property, probably don't use agency debt because it's very stringent and difficult to sort of move within, and their escrows and things can be very tight. They'll hold your money, not give it back to you, make you fix stuff. Work with community banks. So that's why people go out and get things like bridge debt, short-term loans, interest-only loans, things like that when they're doing renovations. And then they take it over and put it into that long-term Fannie Mae, Freddie Mac loan when you go to hold, because then it's so much easier to do the servicing on those, long-term, right? All right, let's say that you might be in trouble. Let's say perhaps you've got a loan that's maturing here in a few months, or you're in foreclosure, or you might be in some issue of the nature. All right, comment there. It's pretty much about the same either way. My recommendation there is to just operate your property, right? If you have a loan that's maturing or you have something coming up, the number one thing you want to do is get your house in order, get your financial house in order, get heads and beds, cheap, safe, affordable. That's all you want to do in your apartment turns. You don't want to be doing renovations or anything crazy like that. Get your NOI up as high as you can, get your rent roll stable, and then hopefully you can approach the lender and get a loan extension. You're far more likely to get loan extensions with a community bank or your fee-based lender. If you have maturing agency debt, that's going to be a little more difficult to get a loan extension. I can't say that you can't do it. I just think that's going to be a lot more difficult going forward. I see an article this morning where they say Freddie Mac specifically is tightening their policy on underwriting, and there's some of their criteria that they're going to be looking at for deals and for people. So I think going forward, you're going to see a lot more creative financing. I think local lenders are going to be the way to go, but they're going to get hammered for a little while, right? We see, if you're watching, office buildings are really falling in value. That's starting to hurt some of the balance sheets over here at these mid-range, mid-tier type lenders. So I think they're going to be a little slow to originate debt right now, but I think over the next year or so, that's going to start to loosen up. And in the meantime, there's going to be opportunity coming. So it's going to be opportunities for operators, opportunities for people that can go out and find these deals from these lenders. I do not believe that the banks and lenders are going to fire sale the real estate. I do believe they're going to foreclose. I do believe there will be multifamily foreclosures, but I don't think that the banks are going to sell them like they did houses back in 2008, right? We saw the banks just fire selling houses at cheap prices, getting rid of them. But we never saw them do that with commercial real estate. I don't think they're going to do it this time. I think they are going to foreclose. They're going to hold on to them, and they're going to put them back onto the market slowly over time with realtors. So you're going to have some relationships with realtors going forward to really see some of those good deals. But I would not expect a wave of fire sale foreclosures hitting the market just at rock bottom prices. I don't think that's going to happen. You're still going to need to have some cash, still going to need to have some good relationships with realtors. But I'm telling everybody, try and talk to the lenders. If you can go meet lenders, if you can get behind the scenes with some of these lenders and pick up some of the deals from them, or let them know that you might be available to pick up deals if they have issues in the future, right? Then I think that's going to be a great way to source deals going forward. All right, so that's what I got for you today on sort of big lenders, small lenders. We got fee-based lenders, we got transaction-based lenders. Mostly just think about the way you interact with them. Fee-based is going to be all about that global relationships, checking account, all the business you're going to be doing there. Transaction-based is going to be about you, the risk of that deal, and the points they're making. So they're going to be much more strict on the underwriting of the deal and of you. That's going to be like agency and CMBS type debt. All right, hope everybody comes down to Tampa. If anybody has any questions about that, certainly let us know. I'd love to see everybody down there. Thank you all for supporting the group, for joining me. As always, invite your friends. I'm not sending out too many invites to the group anymore. I don't want to irritate Facebook. Apparently, they'll get mad at you if you send out too many invites. But everybody invite somebody. If this was good for you, if you got any good information out of here, invite some of your friends. And we will see you same bat channel, same bat time next week. Hey, thanks for checking out that video. If you'd like more information like this, or you'd like to find out how you can work with me directly, go to realestateraw.com or just click the link below.